Hi everyone, so we are back at it for this semester and we're going to start off with chapter 9. Hopefully you've gone in and kind of reviewed and refreshed. I think the biggest thing from last semester from 1303 is remembering debits and credits and what increases our main accounts. Also remember that the cycle that we have. So we start out with making journal entries, then we post to the GL, and then we go in and create an trial balance, and then we do adjusting entries, and then an adjusted trial balance, and then we do our financial statements, and there's 3 of those: the income statement, the statement of owner's equity or retained earnings, and then the balance sheet. Then we journalize what we did in our reports, right? Because financial statements are reports, and so we prepare our closing journal entries after we do the financial statements, and then we go in and do another trial balance, and that's pretty much our cycle. So for the rest of this semester, what's going to happen is we're going to dive into specific areas. Like the first part of it, we have the accounting cycle down. Now we figure out, what do we do with revenue? So chapter 9 and 10 is going to deal a lot with the revenue, all those accounts that started with our fours, as we said. Dive into that area, then we'll have another chapter where we dive into fixed assets. Now, back in the previous semester, we already dove into cash and we learned about bank reconciliations, and we dove into payroll, but we'll also have a little bit more with liabilities. We'll deal some with accounts receivable. We'll get into some other types of structures. Right now we're looking at it as a sole proprietor, somebody that starts their own business. That's why we have in our equity section our capital account. But we'll look at partnerships, and then we'll also look at corporations. And there's a little bit difference in the equity section depending on if you're a sole proprietor, a partner, or a corporation. So we'll learn about that. And then my plan is I would love to introduce manufacturing accounting to you guys at the end of the semester, but if for some reason we get behind or things don't quite work out, we can drop that, and it's not that big of a deal because we'll cover everything we have to for the course by that point. But some of you might end up in a manufacturing situation or in a company that manufactures stuff, and I would like to at least have introduced you to how that works because it's a little bit different too. So when we get through, I think we'll go straight through a lot of the chapters, but then we pick up chapter 23 and 25. So it's not like we're finishing out everything in the book, but we're going to hit a lot of the rest of the book. So that's the game plan that I have. I've got chapter 9 pulled up here. You guys are still welcome to come to the face-to-face class if you need to. I kind of regrouped how I had my Canvas set up. I'm kind of grouping it in sections based on how we're going to test. Maybe that's going to help you guys better than having a chapter per module. There was confusion last semester sometimes with the whole pages and discussions and all that kind of stuff. So I removed the page feature. You guys probably don't see that in your list, so hopefully you'll find it in the modules here. I'm going to try that. Now, if it ends up being too confusing or you know something, give me some feedback, and I can always go back and turn that on for you guys. But maybe this will help cut down on some of that confusion. I'm going to have a chapter where I've got information. That's what I had, and then I'm going to put all the videos separate, kind of like what I did last semester. So let's dive into chapter 9. Like I said, we're talking about sales. So we are going to have some new accounts that we're learning. And I don't know if you remember this magical word from last semester. Some people loved it. Some people hated it. Some were neutral, but contra. Contra accounts mean they do the opposite. So we can have a contra revenue account. We can have a contra asset account. The one we talked about last semester was accumulated depreciation. when we did our adjusting entries for depreciation, that was a contra asset account, meaning it does the opposite of what assets do. So to increase an asset, it's a debit. To decrease an asset, it's a credit, right? Well, when you have a contra revenue account, it means it does the opposite of what the revenue accounts do. So we got to think back to dead core. What increases a revenue? A credit, right? Because it's on the core side. A credit will increase a liability, owner's equity, or revenue account, right? So if a credit increases a revenue and a debit decreases a revenue account, then the contra asset does the opposite. So to put this in maybe real terms or something you guys can tie to real world, you go to Walmart, you buy something, I don't know, not food, because you really don't usually return food, but let's say we buy an outfit and we get home and, you know, who wants to try on stuff in Walmart because they're not just the best dressing rooms, right? So we get home and we try on our outfit and it does not fit, or we don't like it, whatever the reason is. Anyway, we go and take it back. So when we return that, you are now going to be looking at, well, what does Walmart do? What do they have to do to show that they got that item back? Because when they made the sale to us and we purchased it, they took it out of their inventory and increased their sales account, right? Because they made a sale. Well, now we brought it back. So what do they have to do? Well, they have to put it back in their inventory and they have to take it out of their sales, right? Now, we don't really want to mess with the sales account because think of how much stuff is returned to Walmart. Tons. They would constantly be adjusting their sales account, right? So now what we're going to have is a sales returns and allowance account. So it's a separate account. It does the opposite of the sales account. That's why it's a contra revenue account. So when people bring things back and return their items, we're going to notate that in the sales returns and allowance account so we can keep up with it. The other reason for that is you think about, there's a lot of fraud schemes out there, and you guys know how I love to dive into the fraud stuff. I mean, to me, it's just fascinating what people do sometimes. So one scheme is for employees or people in general to go in and buy stuff and then return stuff, but maybe the physical stuff doesn't really happen and they just do it all through journal entries or they scan something. And you guys have been out there in the real world working, you've probably seen people do shady things and then like they sell somebody something for cash and they put the cash in the drawer and then they come back later and ring up a return and take the cash out, but nobody ever actually returned anything. So anyway, as a financial person auditing all that good stuff, you know, your auditors come in and they analyze these sales returns and allowances accounts. And if something looks like it's too high or something's out of whack, then they start questioning it. So that's another reason. If you had it all in your sales account, you'd be going, oh my gosh, trying to keep up with all the ins and outs, right? Okay, so that was a really long way to explain that, sorry. But contra revenue account, we have a sales returns and allowances. Sometimes the allowance part is maybe they give someone a discount, that type of thing. The other account we have this chapter is called sales tax payable. Now payable, remember, the key has pay in it, right? If it's a payable, we are liable to somebody. We have to pay that to somebody else, right? So it's a liability. So it's not a revenue account. It's a liability account. But when, again, the Walmart example, when you guys buy something from Walmart, you have to pay tax on it, right? So they collect the tax and then they remit it back to the appropriate authorities, state, counties, parishes, depending on where they're at, whoever is supposed to get the money. The store sends it to them on a monthly basis or whatever their legal requirements are. So when we start recording these sales, we have to go in and notate and collect that money from the customer, but we can't put it in our sales account. We got to put it in a liability account because we owe it to somebody else at a later point in time. So sales tax, you guys probably won't be too bad. It's going to be percentages when you get it in there to the homework problem. So whatever the sale amount is times the percentage. Don't forget to move your decimal places when you start doing percentages. If you put them in your calculator, 8% would be 0.08. 8.5% would be 0.085. And you'll calculate the sales tax portion. So you'll have a sale and you'll have sales tax, and then we'll also have the cash. And the cash should equal the sales and the sales tax amount added together. So instead of having just a debit and a credit, we're getting more into compound entries where we're going to have multiple debits, multiple credits type situation. So don't let that throw you off. Other things, we can have sales discounts. And so when we issue an invoice, I probably should have a textbook up too so you guys can see this. Anyway, when you issue an invoice, that's not where I wanted it. We'll go back here. We are going to start doing some things that are called credit terms. And we may say, you know, we are willing as a company to give a 1% discount if the customer will pay us in 15 days. So that's an incentive, right? Because if you can get a discount because you early pay, you may want to take advantage of that. And the company who's offering the discount is saying, hey, we're getting some cash flow in, 15 days before we normally would, because normally we give 30 days. So it's kind of like a win-win. So the discount percentage can be varied, just depends on the company, the time period that they're going to allow. Maybe somebody wants to give a 5% discount if they pay within 5 days of the invoice. Some may say we're not doing any discounts. So discounts are an incentive to get the cash flowing and for people not to wait so long on making their payments. They may offer that to customers, but usually what you're going to see is when they're doing it with vendors too. So it goes both ways. So when you purchase something, we'll look at that like in chapter, I think 11, 12-ish. When we buy something from our distributors, our vendors, they may offer us a discount. So we'll also have like purchase discounts. So the sales discounts is what we do with our customers, and purchase discounts is what we purchase, what we buy. So some of this is going to be repetitive. You just got to think of which side of the transaction are we on. Are we selling something to a customer, or are we buying something from a vendor? So a lot of these may end up, for chapter 9 and 10, having accounts receivable involved instead of cash. Some may have cash. So don't forget, accounts receivable has the word receive in it. That means we're going to receive money at a later date, right? Okay. I'm going to kind of scroll through the chapter. You guys, I think, are pretty good about reading the chapters and stuff, or at least figuring out the terms. A retailer, someone who sells goods to the end users, the customers. Merchandise, I call it inventory, but for some reason these textbooks love to use the word merchandise. Maybe we'll just call it merch for short. So that's the stuff. Now, a lot of this is assuming we are reselling. So we may buy something from a distributor or a wholesaler, and a wholesaler is a person that is kind of like the middleman. So you got the manufacturer who makes it, and then they don't necessarily want to sell it directly to the people who are selling it to the end users. There's usually a middleman, because everybody's got to get their piece of the pie, right? So they sell it to a wholesaler. A wholesaler then sells it to the end retailer, and then the retailer sells it to the end consumer. So that's kind of the chain, some of the terminology you may have. Just remember the accounts that may be affected, what goes up, what goes down, that type of thing. Gross sales is the amount that is ultimately the sales. And so when you guys buy something, you think about a car. You buy a car for $20,000, you got to put a down payment on it, right? So that's kind of what this is setting up. They put $1,800 is cash, and the rest of it they're going to pay off later. So the company is going to record that as accounts receivable, but the total sale was $3,000. So don't think that the sale was $1,800. It's $3,000. They're just paying some now and then paying the rest later. So that's another example of those compound entries. We kind of talked about this. Apparently they're going to have, accounts receivable in and out. Now, when someone returns a good, you got to look back to how the original purchase was made. If it was made with cash, then you're probably going to decrease your cash and give them cash back. If the original purchase was on accounts receivable, then when they return goods, you got to reduce their accounts receivable and show they don't owe us as much. Discounts. Okay, so this, where's my little highlighter? Okay, let's see if we can do this. Oh, we get blue. Oh, my goodness. All right, well, hopefully you guys can kind of see that. This is weird looking for some students, and they're like, what in the world? So how you read this? 2% discount. The first number is the percentage of discount if it's paid in 10 days. If not, the net amount of the invoice is due in 30 days. So that's what they worded a little bit different, but anyway, that's how I say it. This means no discount, and it's due end of month. EOM is end of month. You could have a 1, you could have 1/15, you could have whatever combination, but that's how you read it. So the first number is the percentage of the discount, the second number is the number of days, and then the next batch is what happens if I don't make that discount time period. Well, the whole amount or net amount, that's why I say net because that's usually what N means, net amount of the invoice is due in 30 days. So you guys may have to have a little practice reading that, but I think you'll get the hang of it. It looks a little weird. And I want to challenge you to go back and look on maybe any, if you work for somebody, look on maybe some invoices of stuff that they've purchased from people and see if there's some credit terms up there. I don't usually see it on bills for like us as individuals. And I don't know how many people actually physically get bills anymore because everything's so electronic. But if you work for somebody or you have a job or something, you may check that out and see if you can find it on an invoice. You don't have to tell me, but I'm just, sometimes people like to see things in real life. So in this situation, they're talking about the sales discount. So when we go in and calculate it, this is kind of what the calculation is. We take our gross sales and we subtract any discounts we get, and we subtract any SRA, is sales returns and allowances, and then what it leaves us with is what's called net sales. So you're going to want to remember this formula right here. In this transaction, apparently the customer bought something. I didn't read that on the other page. The customer bought something and it was on accounts receivable, and we have to watch our invoice dates. Apparently she's going to pay her bill on July 24th, and that was within the 10 days of the date of the invoice. So she must have bought it on July 14th. And so she's going to pay it within those 10 days to get her discount. So when we get the receipt of the payment from Michelle, we're going to get cash. Now the cash is going to be different from the amount that's on accounts receivable. She still owes us apparently $40 here is what they're saying, but she's only paying us $39.20. So the difference between those two represents the discount. So remember, your sum of your debits have to equal the sum of your credits in your journal entry. So apparently if you went up here and did the calculation, 2% times 40 gives you 80 cents. And when you do that 2%, it's 0.02 times 40. Don't forget to move your decimals. Some people will put 0.2, and that means 20%. Not good. So definitely watch your decimals. So that's another way you can calculate it and say, okay, she's going to get 80 cents. So if you subtracted 80 cents from $40, what she should pay us is $39.20. So there's a couple different ways. Usually with math, you can look at things 2 or 3 different ways. It's whatever clicks for you. Doesn't matter to me as long as you understand that a portion of this is the discount, however you want to work the math out for you. Sales tax payable, if the good was $1,800 and there is a tax rate of 5%, you multiply those to figure out the amount of tax. So what the customer is going to give you is the $1,890. And probably the next page we have this wonderful journal entry. So they're giving us $1,890. I like journal entries better than these T accounts, but maybe you like T accounts. They give us the $1,890. Apparently, they're splitting some of that out into accounts receivable. Maybe they didn't pay the full amount. Sales tax payable is $150. So if you took $3,000, let's do the math on this. If you took $3,000 times 0.05, that comes up to $150. So you know sales is $3,000, tax is $150, and apparently they must have split what they're paying on their cash. The problem was going to tell you how much is cash and how much is, accounts receivable type situation. I want you to make sure you know that sales tax payable portion is going to that liability account. We have subsidiary ledgers. So when we get into accounts receivable, we got to know who owes us money, and so we may have a subledger there, and the sum of all those subledgers will tie into what is our total accounts receivable balance. So they're giving you a problem here. I think they're trying to show you how an invoice is. Not all invoices look the same. I wish I could make like a bunch of copies for you guys just to show you. If you guys ever go out to like Google and just do a search for invoice templates, oh my goodness, you will see there's all different types of formatting for invoices. And I think if you guys remember from QuickBooks last semester, I know I showed the face-to-face class. I think I showed the online class too. Like you can pick different templates even in QuickBooks depending on what type of company you are, how you want your invoice. So anyway, they're just trying to show you. You got to watch. You're looking for dates. You're looking for invoice numbers. Sometimes you need to document that. We had to do that in QuickBooks. You're going to have credit terms. You have your quantity, your prices per unit, and then you get your totals down here. You may have another line for sales tax, customer name, that type of thing is going on. Let's see what else they got in this chapter. So we have, like I said, these sub-ledgers. So we're going to have a T account just for this company, and we're going to have a T account just for house clothing, and a T account just for Mel's department store, or what they also call a sub-ledger or a subsidiary ledger. And so we can keep up with exactly how much each of these people have paid us and charged on their account. And then, like I said, the sum of all of the sub-ledgers should match up what's into our accounts receivable. So when you guys, that's what they're trying to show you here, all these accounts receivable has all these other little people that feed into it. When you guys start doing journal entries for accounts receivable, you may have to pick in your drop down who bought the goods, because it's wanting you to get in the habit of picking those specific customer names. So you may have to watch that. They call AR, the main AR account, a controlling account, and then we have all those sub accounts. So even when we make a journal entry, we're coming in and saying accounts receivable for Bevan's company, accounts receivable for Bevan's, accounts receivable for Roe. So we have to start notating so we know who owes us money, because that's not fun when we don't know who owes us. We can't collect on it, right? So again, they're just showing you the controlling accounts, and then the subledgers. All of these tie into accounts receivable. Okay, they spend a lot of pages on that, but I think you guys will pick that up really quick. Let's see, journalizing and posting a credit memorandum. All right, a credit memo. Maybe you've heard it called that. Or a CM. That's also a term. That's for when people return stuff to you. I'm really not going to be worried about all this posting stuff because honestly, you guys are going to get out there and they're going to have automated systems, and they're going to have a form or something that you click and fill out for the credit memo, and it's going to automatically adjust to the accounts. But what they're showing you, they're just saying that this check is here, and they're making sure. Remember, these posting references are what account numbers are getting posted to. So accounts receivable, Bevan's company is going to have its own accounts receivable number. And then Hal company is going to have its own accounts receivable number. So we're going to get a little more detailed with our chart of account numbers than what we had before. But remember, if it starts with a 1, it's a asset. If it starts with a 2, it's a liability. You guys remember all that? Now, I know we said 3s start with equity and we said sales were 4s. I don't know why they have these as 3s, but just go with whatever. In real life, usually 4s are revenues. I think the rest of the chapter is pretty much just kind of doing the journal entries and going back and forth. Homework shouldn't be too bad for you. Making sure you understand the accounts. You may have a schedule of accounts receivable. All it is listing everybody and what their totals are, what their balances are, and you get a total number. Nothing major there. Some of you, from what I looked this morning, already got homework done. Awesome. Hopefully it wasn't too bad. Some of you, I think, are still easing back into things. No worries. I just wanted to try to get a video out there for you. So that is pretty much chapter 9. Let me know if you have questions. I don't think I'm going to do a specific one on homework. We'll kind of glance through the homework problems here real quick. I think they're pretty self-explanatory. First problem, you got to pick categories. And remember, if it says book static, it's straight out of your book. So if you want to look up this T section, I don't know if it's in your book or not. I think it is. I think it's before the concept checks. Anyway, I try to keep it simple, just refreshing. What main category are they in? I think it's going to ask, is it increasing or decreasing? And therefore, does that mean it's a debit or a credit? And remember, normal balance means whatever increases that account. Kind of the same thing, concept check. This one's having you go in and calculate the net sales, so it's just wanting you to put them in the right order. This is saying this number minus this number minus this number equals this. Remember, double lines mean final number. Single lines means it's subtotal. So you're going to have to do some type of math, add or subtract. This is just working through, making sure you understand and can use the T account. Remember, debits are always on the left and credits are always on the right. Now, as far as what increases or decreases, debit and credit mean different things depending on which type of account it is. So these are like similar type things you've had. This one's doing journal entries. So letter A, how would you record that? So you got practice there. More journal entries. So you guys know I like to wear you out with that. Practice before the test. This one's going in and you're just calculating the discount. You got to put the accounts in there, I believe. More journal entries. And more journal entries. This one's a problem, so it's going to be a little more challenging. More work to do, but I've got you working on journal entries again. So you get stuck on something, let me know. Oh, this one's got 16 parts, so it's going to be a lot of, you got to journalize them, and then you got to put them in the subledger, and then prepare a schedule. So you can do it. It hopefully won't take too terribly long, but more that you practice this, the better you get at it. And plus it's going to help for other chapter, like chapter 10 still kind of goes along with this same concept. All right, guys, I think I've talked your ear off, so let me know if you have problems, and we'll talk on chapter 10.